welcome to Tea Time with me, Shaili Chopra. Today is a guest who really knows how to swing when the markets decide to swing otherwise. A man who manages wealth for Ultra HNIs is going to be on the show giving you a perspective on where these markets are headed and whether or not it's a good idea to swing on the golf course when the markets swing otherwise. Rajesh, welcome to the show. Thanks very much.
Pleasure.
I noticed you've got your target right on the green. That's now it is not how it is when you're on the stock markets, right?
Yeah, many a times there's a miss.
Yeah, many a times
Yes,
it's a miss. But
right.
How hard is it these days dealing with a very volatile market even as it makes a comeback?
No, I guess if you educate the clients in the proper manner and you've set expectations right, it's easier.
But you've been around with ASK since 2006.
Right.
So that's a long enough period for you to see a few ups and downs, and really more downs than ups, let me put it that way.
Right.
Has it made the concept of the wealth management a lot more challenging and therefore increased the barrier for entry of people?
Now, I've been involved in wealth management for the last 15, 16 years. So I've seen 3 or 4 bull markets and bear markets.
Yeah.
I don't see much of change except the kind of products that we have has changed.
Yeah.
And,
for the better or worse?
For the better.
Okay.
So it decreases. Earlier there were only equities and bonds. Today there are many more types of products for the ultra high net worth individuals.
Yeah.
So it reduces the volatility in the portfolio.
Yeah. Well, you know, somebody who would want to know the basics would say, what is an ultra high net worth individual? How do you define the ultras?
The way we define it is to really look at how much of money they have to give us to manage outside their real estate and business.
Yeah.
And that's roughly about $5 to $10 million.
But do you see that some of these HNIs are rushing to pump in money into real estate, something that we had seen grow over the last 2 years in a big way? Sudden rush to park funds in property as opposed to keeping them in equity.
It's not sudden. It's been there for the last 15 years. And it differs in regions. North, most of the clients prefer real estate, have always invested in real estate.
Yeah.
In Western India, it's more capital markets, financial markets, and South, again, it's real estate. So they've always...
Stark differentiation.
Yeah, stark differentiation. It's really about, you know, what you understand well. And North clients and South seem to understand real estate much better. And something which they can touch and feel, so it's more tangible.
But the stock market is used to all bunkers, yeah? It's sort of attracted towards it, isn't it?
So that's...
every now and then, for every rise, there's a trough.
I mean, there are 3 things that are always related to the stock market, especially for investors. One is what we call knowledge. Second is discipline. And third is temperament.
What is the most important? Discipline?
Temperament.
Temperament.
Knowledge, quite a few people gain over 8, 10 years. But temperament is where people lose out because of the volatility. They react, not in the right manner. So
like in golf, yeah?
Yeah.
Temperament can change it.
It's a mind game.
I see.
Second thing is really about discipline, getting carried away, hearing about, reading about various stocks they need to buy. Some friends tell them at a party, they go and buy. They always lose money in equities. You
know, it's always a dilemma. Should one go in depth into reading about the company? Is that something that will really give them a sound decision? Because you could well read a lot about a company. Much of that could be unfounded and yet go wrong.
If you're an investor who doesn't have the time and is involved in work or business, then it's better to go through mutual funds or portfolio managers where you do your homework on the fund manager and their performance and then let them do the job. But if you're really keen to invest and you yourself have the time, then it's a combination. It's not like you rightly said, just by reading balance sheets and reports, you won't make the right decision. It's also at what price you're going to buy. You have to also go and meet the management and understand the quality of management, etc.
So your tools are very important, just like the right club you select for the right shot to overcome water, fear and everything else. And therefore, that's really very key for the stock markets too.
Right. One way to select clubs is just to look at distance, right? The other is the lie, the way the elevation of the green. So there are many things that will decide what club to use, not necessarily the distance.
That's right.
So getting to know the distance and choosing the right club is easy, but it's those other aspects that people miss out on.
Yeah, which are really the finer points, right?
Right.
But, as a person who moved into the stock market, what was your attraction? Why did you choose this field to excel in?
I was with Standard Chartered doing wealth management.
Yeah.
And that's not necessarily stock markets. Before that, again, with Xerox, So I've been with MNCs for 17, 18 years. ASK was an entrepreneurial opportunity. I met the promoters. They themselves have created a big name for themselves in the capital markets and portfolio management.
You were kind of inspired by Asit Kotecha, right?
Yeah, Asit, Samir, both brothers, first generation entrepreneurs. They've built the business and their philosophy and vision was absolutely right. It matched what I wanted to do, which was primarily creating a client-centric business model. And it gave me the right platform. Plus, I joined them as a partner. So it was also moving away from just being a service guy into an entrepreneur.
Yeah. But what did you think was the biggest lesson you learned as an entrepreneur, something you may not have learned on course as somebody who was servicing, another person's company?
Two big learnings. One is when you look at a business as your own, then there are many other financial aspects that you need to consider. When you're working with an MNC, etc., most of that is taken care. But here things like return on capital, how much money you're putting in, what returns do you get, and why profitability is most important, not necessarily top line growth, but how bottom line functions. The other thing was really about wealth management and capital markets. They've never done broking. As a philosophy, I've never believed in broking. It's about long-term investing.
Right.
How long-term pays off over a long period of time. We never thought of those things, So.
But I know everybody, including yourself, would talk about the long-term. A large number of people are very uncertain what this long-term is.
Right.
Because you do invest in the long-term.
Right.
And then even in the long-term, you don't know when to sell out. So technically, a lot of people just don't end up making money in the long-term too.
Right.
Do you think sometimes that is a dilemma that lies there? What is the long term? Who defines it? And what will it bring on the table?
Right. I think long term is defined by, you've taken some historical data. And that historical data shows that, especially in equity markets, you have to stay invested between 5 to 6 years. And you get a bull and bear phase. So even if you invested at the highest point, and you've stayed for 5, 6 years, you've never lost money. And there's enough and more data to prove that.
Yeah.
That's really how long term gets defined in equity markets. Similarly, in real estate, when people buy, they don't look at flipping over real estate in 1 or 2 years. So again, 5, 7 years is what we typically call long-term in real estate, while fixed income products work differently. So I think it's really based on historical data, that equities, and there's enough data to show that you stay invested for 6 years, you will not lose money.
What made you take up the whole finance stream? Was it what was hot in those days as you were growing up?
I like numbers, and personally I was, right from college days, I was involved in the stock markets. And,
and how's that? College days in stock market?
Part-time.
That sounds like you were making more than just pocket money.
My college was bang opposite Bombay Stock Exchange, Elphinstone. And college used to get over by 11:30, 12. At that time, markets used to start late. So good pocket money, and that's really where I learned
what was the first stock you bought?
Oh, Tata Steel.
Really?
Yes.
Still exists? Tells us the company's all right.
And there are many companies that still exist. And that's really the beauty of equity investing. You have to really work hard to lose money in equities. A lot of people get into speculation. But if you buy good businesses, you don't have to sell. You'll still compound at 15
So today, if you were to look at this market scenario, this sort of corporate palette, what stocks are making sense to you from a good company point of view? Long term in your language.
There are many. There are really good businesses across different segments. I think more than the companies, it's also about what price you get in.
Yeah.
So whenever markets are really bad and volatile, that's the time you get the best opportunity to start investing in good quality businesses. So be it in the infra space, there is Larsen & Toubro, Thermax, Cummins. Then
all these at Sensex 15,000 or Sensex 18,000?
Sensex doesn't have any meaning. It's really about...
I meant from a market cycle point of view.
Right. So as a philosophy, cycle and markets mean nothing to us. It's really about the business and whether that business is doing well and at what price you're buying it. So when you buy a stock, you're paying a price. What you get is value. So you have to really see whether the price and value is matching or there is a gap. Are you getting something worth 100 rupees at 80? Then markets can go wherever. But if you invest at that time, you really don't lose money.
As a wealth manager, what is your first parameter? What is the most common sense parameter? Do you look at price to earnings? Or, what do you look at as a first parameter on a stock before you call it cheap or expensive?
Oh, on a stock? See, firstly, as a wealth manager, our role is not just stock picking. It's really about getting to understand the client's financial goals, cash flows, long-term investment objectives, etc.
Equity versus debt,
and then you allocate money across different asset classes. Now, within equities, We typically advise clients on mutual funds and portfolio management. We don't tell them, to buy direct stocks.
Yeah.
And when we look at equities, then there are 3 or 4 things. One is quality of management. Second is return on capital should be extremely high. 25% plus is what we look at. Then we look at earnings growth being 25% plus, predictable. And fourth is the business that they are in should have entry barriers, should be unique. Or it should be growth oriented in the economy. So these are 4 things. Quality of management being extremely important. So, and lastly, when you're buying it, you should be buying it at a discount to the actual value of the company. So if it's worth 100, only if you get it at 75 in the stock market, we invest. So it gives you a margin.
Did you ever
of
have
safety.
a guru in the stock market who you tracked?
Guru internationally is Warren Buffett. So, his philosophy, his style of investing is what personally, I believe in.
Yeah, he loves golf. I know that.
And in India, there have been very good quality fund managers who still exist. Bharat Shah, who's with ASK itself. Then there's Prashant Jain of HDFC. Then Kenneth of IDFC. Very good qualities managers I've always experienced in 15, 18 years. And they've consistently performed over the last 10, 12 years. So if you look at some of the mutual funds, you go back 10 years, they're still compounding at 18, 19%. That's what I meant, that you really don't have to really look at the Sensex on a daily basis to make money in it.
Where do you see yourself going? Is this where you want to sort of call it a close with entrepreneurship being a part of your, business now? Is this what you'd always aspired for?
Yes, absolutely.
After this is golfing all the way.
Sure, golf will always be a part of my life. And even with Standard Chartered or Xerox, I've always worked with startups. In Standard Chartered also, we set up the whole wealth management unit. So I've always enjoyed that. Here, you're also a partner, so that makes it even more interesting. And I guess being able to build something that you always thought of doing. Also, I think one of the big things in wealth management is continuity in relationship. A lot of relationship managers or advisors keep changing. But when you own or you're a part of a company, then you can offer continuity to high net worth clients.
It's an interesting point because I was going to take you through what this crisis has done generally to wealth management. A large number of international players, both on private wealth and otherwise, have wrapped up. Many of them in India have closed their businesses. Many of them have not been able to sustain themselves, or they find it too expensive to sustain what would be a large relationship-led team. How are the times changing for the wealth management business?
No, clearly margins have been under pressure, especially for wealth managers whose core proposition is broking. And with so much of competition, with broking margins having come down, whenever the markets remain bad for 2-3 years, it affects all wealth management firms whose core proposition is broking.
But even the global firms, any of the global banks that try to set that up, they are continuously finding that that's one place that bleeds a lot more even today.
I guess resources are scarce, and some of them I feel get their cost model wrong. So in the business model, they come in, they take fancy offices, hire expensive advisors at huge prices when money is not to be made. So they face that challenge. Earlier, they had 10-year, 15-year plans because internationally they were doing very well. But over the last 4-5 years, because of international operations also going through a tough time, they've really started to focus on, getting the Indian operation to deliver quickly. And that always becomes a challenge.
So Rajesh, what is your business mantra? And is it hard to keep up with a business motto when you are dealing with clients and the markets?
It is hard, but my business mantra for our company, it is integrity to clients and investment performance. These are 2 things. So even if markets are bad or performance is not good, if you really show integrity, you're being transparent, you're guiding them the right way, there's no issue at all. So that's most important. And over a long period of time, you have to deliver performance. In India, they don't care much about, you may be very conservative, but if you don't get returns for them, then it doesn't work well.
So clients are tough, right, in the Indian context?
Always.
At the end of the day, it's their money.
Because in their business, they earn good return on capital, right? So if they're going to invest outside their business, they look at pretty much similar returns.